Thanks, Richard, and good morning. It's a great pleasure to be here at the Revenue Summit. Now, yes, as Richard said, I am an economist. So you might have heard the saying, an economist is a man who states the obvious in terms of the incomprehensible. So I'll do my best. I'm not a man. I think what I am stating is a lot of the obvious. So I'll do my best not to make it incomprehensible. But you never know. Anyway, we'll start really simple. If you want more revenue, tax cuts aren't the way at it. So we're still on obvious points. I have been looking for some time at the consequences of what would happen if you reduce the rate of company tax. Now, this is something that obviously our friends in the business lobby, who you've talked about already, would like. So the thing is, it's kind of tricky. So they can make a case for cutting company taxes that from some angles looks quite appealing. And that's how this got so incomprehensibly complicated. So this idea, it harks back a long way. But in my world anyway, it harks back to Scott Morrison's first budget in May 2016. And I thought it was going to end with the demise of Malcolm Turnbull's prime ministership in 2018. And in fact, it did go away for a little while. But tasked with finding ideas to a more dynamic and resilient economy, the Productivity Commission this year revived the idea of corporate tax cuts with some modifications from the Morrison-Turnbull policy. But essentially, their draft recommendation in their interim report is to reduce the rate of company tax to 20% for firms with turnover below $1 billion and to leave it at 30% for firms with turnover above $1 billion. So just for context, at the moment, the company tax rate is 30% for firms with turnover above $50 million. So this is a big tax cut really for firms between $50 million and $1 billion. Now, the Productivity Commission also recommended a net cash flow tax, which is a better idea, actually, when it comes to raising revenue. And I'll talk more about that later. But firstly, I'll just go through the mechanisms behind a company tax cut, because that was what was given the headline billing. So at the risk of straying into the incomprehensible, I'm going to unpack those mechanisms and try and make the case that a company tax cut at best doesn't achieve anything, and at worst makes us worse off as a nation. So at the centre of policy studies, our economy-wide market-based modelling of short-run and long-run effects finds that a cut to the company tax rate will stimulate investment and wages. At this point, the Business Council leaves the room. Says, "We've made the case. Let's do it." And in fact, I went to a Senate inquiry where I was very naive. Actually, I went in as an academic thinking I was going to convince the room, but in fact, I was basically there to perform and after the advocates on both sides of the room got me to either repeat what I'd said or simply say, "So, Professor Dixon, will a company tax rate stimulate investment?" I said yes, and the Liberal senator said, "Right, that's all, thanks." Anyway, so the tax cut creates that incentive to expand investment, in this case by giving viability to investments that are profitable at a 20% tax rate, but not at a 30%. Right? So at a 30% tax rate, there are investments that are left behind, but at a 20% tax rate, some of these things become okay, they become viable. So that's the stimulus argument. That facilitates this small positive stimulus to economic growth. It's not the best stuff. The best stuff's already being done. The best stuff's profitable at 30% tax, right? But this stuff that's profitable between 20 and 30% tax becomes viable under a tax cut. So yes, facilitates growth. But what do we mean by growth? We mean gross domestic product, in GDP. It's a measure of all things produced in this country. Now, with more investment, GDP will be larger. That's the economic growth dividend from company tax cuts. Now, despite many flaws, usually GDP is a pretty good proxy for welfare because we do own most of what we produce here, right? Most of GDP. But as has been pointed out, we don't own all of it. So a better measure of welfare is in fact gross national income. Let's look at that, the part that we own. So that subtracts the part of GDP that accrues to the foreign owners of capital. Now, side story. In Australia, we have dividend imputation, which is in place to avoid double taxation of business income. So if you've paid company tax on the surplus generated by your business, you'll get a credit on your personal income tax. So you're mostly actually indifferent to the rate of company tax. If it's high, you'll get a high credit. If it's low, you'll get a low credit. So it all comes back to your personal tax rate. So it's the foreign investors who don't get to do this. It's the foreign investors who really care what the rate of company tax is going to be. So they're the ones who are most responsive to a change in the company tax rate. So if we drop the company tax rate, this points to a widening gap between GDP and national income, right? So just because GDP grows, it doesn't follow that national income will also grow. This is really important. Now, why this gap? Two reasons. The first is all the new stuff, foreign financed. The surpluses from that will accrue to the foreign owners, right? Maybe we can take that. But the second, and this is really important, is that there's a whole lot of foreign capital stocks, foreign-owned capital stocks already installed here. We're giving a tax cut on the incomes generated off that stuff as well. Now that all the foreign-owned capital stocks that were already installed in Australia before a tax cut have de facto voted in favour of that tax cut. They were like, oh yeah, 30% tax, do our sums, yeah, worth it, right? And we're just going to give them a tax cut. That's just giving money away, right? So, and this comes straight away. This is the upfront cost. Now, over time, yes, you get a little bit of a gain on those marginal investments, the ones that you know, couldn't bear 30% tax but can bear 20%. And so you claw a little bit back, but not enough. It is not worth it. Now, so as lower tax cuts are phased in each year as a nation, we'll miss out on a chunk of tax revenue that we otherwise would have collected from the foreign investors. So this has a negative impact clearly on government revenue. But let's think a little further. If we've got less government revenue, perhaps we want to still run a balanced budget, we're going to have to pick up tax from somewhere else, right? Cue the nurses, cue higher HEX payments, right? So if we're not going to collect as much tax from the foreigners in one way or another, we'll have to collect more from the domestic population or provide less services, right? There's no way the domestic population wins from this. Now, so this is why I would say it's so important to look at the policy change from all angles, short run and long run. Now, our study and all the studies we've done until now do both, right? We look through the implementation phase and out through to the long run. So we look at everything. Now, studies that find in favour of a company tax cut will tend to only look at that long run. So they jump there, straight there. So you have your country as it is, and then you say, what if the tax rate was lower? No, don't worry about the transition. Just what if it was lower? Yeah, okay, GDP would be bigger and incomes might be a tiny bit bigger. But once you take into account that upfront cost, that gain's gone, right? So we must look at short run and long run. We must look at GDP and domestic income, right? Once you've looked at it from all those angles, it doesn't stack up. I want to talk a little more about wage growth, because wage growth is one of the sort of benefits from cutting company tax that's sort of talked up as, well, we've got to do it for the wages, right? So now, how does this work out? Okay, if we've got more investment, like a larger capital stock, that should drive more output per worker, and that should drive higher wages, right? Now, because of dividend imputation, it's really not that effective for domestic owners of capital, domestic businesses, this tax cut. So it is effective for businesses with the large foreign shareholdings. Now, when businesses with large foreign shareholdings expand, they're going to draw in resources, right? Workers. And they're going to be able to pay them higher wages. What happens then to the domestic businesses, right? we've got a population of a certain size. We haven't got really high unemployment. So what happens to those domestic businesses? They're going to lose workers. They're going to have to compete in this labour market where the foreign-owned businesses have now been facilitated through a tax cut to pay higher wages. So this is not a policy, despite being, touted by advocates for small business and local business. This is not a policy that's actually helpful to small business. It's going to make things more difficult for small business. So, but what about the workers? Won't they benefit from the higher wages? That sounds good, but it's basically an illusion. Remember, gross national income is less, right? So workers may have higher pre-tax wages in their bank accounts, but they'll either have to pay more tax themselves to shore up the budget, or they'll be suffering under a government that's got less budget to spend on other things. So there's no way that this works out well for anybody domestically. Now, there's one last point I want to make, which is that it's often said that lower company taxes create more productivity. I'd just like to clear this up. So as I've said, lower company taxes at some margin lead to more investment, creating more useful capital stocks, meaning workers can produce more output. That is not the same as productivity. Let's go to the textbook example, which is always about digging holes. So if you have a lot of holes to dig, you'll get it done quicker with a digger than with a shovel, right? So often that's at the point where you close your textbook and say, yep, I've understood productivity. Because undoubtedly output per worker is improved by having a digger. If you're only thinking about digging holes, where did the digger come from? Who built the digger? Does anyone in here know how to build a digger? Because I sure don't. I'm not even very good at digging holes with a spade, but I could probably figure that out. So would you rather dig a hole or build a digger? Digging a hole is probably easier than building a digger. Now, digging 10 holes, that's getting a bit exhausting. Or digging like a really massive hole to stand a building in, yeah, that's getting really tiring. At that point, a digger's probably worth it, right? But you must take into account the effort of building the digger, right? It's not that digging a hole with a digger is a better way of digging a hole. It's building a digger and then using the digger to build a hole. Right? Is that better than using a shovel? Maybe. Probably, right? There's lots of diggers out there. But, I'd still use a spade, say, for example, in my own garden. So, it does depend on scale, perhaps, and whether you've got enough money to purchase a digger. So taking this more holistic view, genuine productivity growth needs to compare the effort required to dig holes with a spade to the effort required to dig holes with the digger and produce the digger. Right? Now, this is the big thing about cutting this company tax rate to create more capital stocks. Right? That is not necessarily productivity growth. That's just putting a bit more effort into building the digger. It's not necessarily productivity growth. So it's not necessarily a clear win. So if we get more diggers just because of a tax cut, right, now let me go back. If we get more diggers because we've thought of a smarter way to create diggers, yeah, productivity gain, that's good, right? And this happens every year. We think of smarter ways to do things. So that would be fine. That's a productivity gain. But more diggers just because of a tax cut isn't a clear case for a productivity gain. Right. So the PC's draft recommendation, Productivity Commission's draft recommendation, is to cut company taxes only for firms with revenue below $1 billion turnover. Now, the majority of foreign ownership is probably concentrated in those really large firms, which are still subject to the 30% tax. So I take a little bit of comfort from that perhaps all through 2016 to 2018 when we were debating this, that something got through, right? So I take a little bit of comfort from that. We won't be giving away as much revenue as that original Morrison-Turnbull plan. So that's a good sign, but nonetheless, the mechanisms stay the same. It's an upfront loss of tax revenue followed by a growth in investment that facilitates a gradual but incomplete recovery. Now, lastly, I just want to touch on the idea of cash flow tax. I think I've got about 30 seconds left, but I'll lead into the time for questions, and they're always awkward. So if we're looking for revenue, a cash flow tax might be part of the solution, right? And a cash flow tax is part of the PC's recommendations. And the key here is that a cash flow tax treats investment like an ordinary expenditure. So it's a deduction. It's an expense as soon as the investment's made. So what this means effectively is that a cash flow tax will collect more tax on highly profitable investments and very little on marginal investments. And it actually doesn't change the incentives to invest. So this is a way of collecting more revenue without scaring off investors. Now, clearly, business lobbyists hate it just because they'd like to have more, but it doesn't actually turn any profitable investment from profitable to non-profitable, right? So cash flow tax could be part of a solution going forward for more revenue. Thanks for your time this morning. So back in 2016, when my co-author Jason Nasius and I started modelling the effects of company tax cuts, we were widely berated for going against the conventional wisdom, which was, as far as we could tell, that lower company tax cuts would lead to higher GDP in the long run. As I've said, we actually agree with that wisdom. We just think there is so much more to the story.
Was that work? Dee just told me how to make it work, and then instantly.
You could stand here.
Loaded now. Stay there, Janine. So Senator David Pocock's coming up next, but like Larissa, he's in the chamber debating something at the moment. So we've got a few minutes for some questions, and then we might flip the order around. We've got a presentation from former Queensland Premier, now Queensland Opposition Leader Stephen Miles. So Dee and I are on tenterhooks to figure out when David will come, but we'll wing it between now and then. So if you've got a question or so for Janine, have a think. Make sure it's a question, not a comment. And I'm going to throw the first one, which is a bit of a Dorothy Dixer, but we haven't rehearsed it, that I know Janine's previous work. We just know in Australia, if we listen to the ABC, because, that's where business goes to tell us how to think, that cutting company taxes is good for the economy. If tax cuts cost a lot of money but have long-term benefits in terms of investment and blah, 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 why is Australia so obsessed with boosting GDP or, as you say, more importantly, GNI through tax cuts? Why don't the same arguments get applied to the benefits, for example, of making childcare far cheaper or free and in turn stimulating a boost in the number of people working? How come... I know you've modelled it, but why do you think we kind of just always ask the question about, are there some benefits from tax cuts rather than of all the ways to affect the economy, which one is best?
Yeah, that is a tricky question. I think, I probably don't necessarily take these different debates and offset them against each other like that. I do think though that the argument to cut company taxes is a little bit complicated, right? As I've said, because it does increase GDP, so it's been really strongly advocated by people who gain from that, and so people like the Business Council, they have highly skilled media people, lobbyists, and so forth, so they can go forth and make these arguments. If you just give half the story, GDP will be higher in the long run, it sounds all right. Yeah. So it's really up to other people then, like you, Richard, to put out the rest of the argument. Now, I think the irony is that business people know that almost anything you build will generate some income in the long run, right? But that's not really the question. The question is, will it recover its costs and actually make a profit, right? If we just looked at things that would generate an income, I'd have a train line to my house. But I'd certainly be a train line perhaps from Melbourne to Canberra. The thing is that even though these nice things generate a return, if they don't cover their upfront costs, we don't do them. And in a sense, the same applies here to this company tax cut, that there's this upfront cost while we're implementing it and saying, look, businesses, you install these investments, so in a sense you voted in favour of 30% tax, but we'll let you pay 20%. Right, so while we're giving that away, that's the upfront cost, and sure, we might get a benefit later, but our argument is just that it doesn't cover.
I think I see a question up the back.
Hi, Professor. Thanks for your address. Way up here. I think, like a lot of voters, I'm constantly amazed at the number of companies, particularly foreign or multinational companies, that pay zero company tax in Australia. And I just wonder, are we especially toothless in Australia, or is this a global phenomenon that these companies that have either a small number of employees here or none pay zero corporate tax?
Yeah, so I don't know if we're especially toothless. Well, perhaps we are. But I think the point is that if your company tax rate is higher than another country's, then businesses will make the effort to get their profits domiciled in the place with the low tax rate. And our tax rate is fairly high by international standards, which is fine, right? Because if tax is like a fee for service, a fee for being here, and we're awesome. We have an educated workforce. We have really great resources and minerals. We have a stable kind of political system and so forth. So our tax rate should be high, right? But if you can create some sort of huge import expense to your other subsidiary in Singapore and then go and pay less taxes, then yeah, you would. And so it's then up to the ATO to make sure that we defend this tax rate by making sure that businesses are complying well. So there's sort of two things here. That one is the policy as it should work, which is, as an academic with a model, I'm on that part. But clearly then how it operates in the real world and how it's defended by the tax office is really, really important.
I'm going to trust you with the mic because you're going to ask a question, not make a comment. I can feel it.
Thank you, Professor. Transfer pricing with international companies. How did your modelling take that into account? And just explain what transfer pricing is and inflated transfer pricing, please.
So our modelling took that into account by having both a headline tax rate, which is, the legislated rate, 30 and cutting to 20 and so forth, and then an effective rate, which takes into account things like transfer pricing. So I think the way I like to think of this, the simplest way I like to think of it in my simple mind is that it's about creating these sort of bogus expenses, right? And essentially pushing, if you create this big bogus import from somewhere else, right, that somewhere else subsidiary, the one in the low tax country, makes the profit. So, a long time ago when I was a graduate student in Ireland, in the years of the Celtic Tiger, the company tax rate there was 12%, which at the time I just thought Ireland was a really expensive country, but after a while I realised it's because their company taxes were so low that they'd created this really high demand for everything else, so housing and so forth was outrageous. But anyway, so I rock up this Australian student, and after a short time my supervisor said to me, now, you need to be careful about how you measure GDP and gross national income. And I said, they're the same, aren't they? Like, yeah, barely different. And he looked at me, and so I rushed off to the library in those days and discovered that, in fact, gross national income in Ireland was 30% less than gross domestic product. So this is the consequence, right, of having a really low company tax rate. The place looked like it was booming, but in fact, domestic incomes were not really that strong at all.
Just to give everyone a simple example of what we're talking about with this transfer pricing, and the ATO have had some success in this regard, but a lot of mining companies in Australia have managed to make no profit at all selling resources we gave them for free. No profit, I tell you. Not a cent. But their marketing hub in Singapore, very profitable. Turns out all the money's in the marketing of coal. The coal is worthless, the extraction is worthless, all that capital equipment invested in the mine, regrettable. This didn't make a cent. But those marketing folks in Singapore,
They were really expensive, those
they earn a buckler to these guys.
Yeah.
So that's what we mean by transfer pricing. So we'll play this presentation from Stephen Miles in a sec. We're going to have one more quick question that won't be a comment.
Certainly not a comment.
It sounds like the marginal investments that you mentioned between the 20 and 30% tax rates would create brittle jobs that would disappear if those tax settings then revert back. Do we have any evidence or examples of firms that have increased their viability before a reversion like that has taken place, or are we then burdened with those firms as a society?
Yeah, I can't speak to any evidence of actual firms. And I mean, the company tax rate was cut in 2016, and it hasn't been reverted back. But yes, there are always, every year businesses go out of business and there's lots of entries and exits, particularly at that marginal sort of level and particularly around those small businesses. So as for jobs being brittle, obviously people lose their jobs and this happens. But unemployment, at a very macro level, unemployment is not high. So the argument around, creating more capital and creating more firms, it's really more about wages than it is about jobs.
Okay, we're going to, again, flick the order of things around a bit. But before we hear a presentation from Stephen Miles, can you please all join me in thanking Professor Janine Bitson?
Thanks for watching, and a very special thank you to all our supporters who help keep us running. We're not funded by political parties or fossil fuel companies or government, but by people like you who know the importance of evidence-based research in shaping the critical decisions facing Australia. If you'd like to support us to continue exposing inconvenient truths, challenging vested interests, and explaining the big issues in plain English, please consider making a tax-deductible contribution today. Visit our website australiainstitute.org.au to find out more.